Private banking has been in the shadows for a while now, underperforming and failing to excite investors. But all that has started to change. Today, we're diving deep into why private banking could be the sector of the year. From FII inflows to economic recovery, we'll break down every crucial factor that makes this sector the one to watch. So stick around till the end. First, let's address why private banks have struggled for the past few years. The reasons are more than just market sentiments. There have been fundamental issues affecting this sector. Foreign institutional investors have loved Indian private banks historically. These banks have been among the top holdings of FIIs for years now. But in the past couple of years, they had been selling off aggressively, putting downward pressure on the stock prices. So, why were they selling? Several reasons: global interest rate hikes, geopolitical tensions, and a shift in investment policies towards safer assets. India, despite being one of the fastest growing economies, saw significant outflows as FIIs reallocated their capital. The good news? FI exodus seems to be over. After hitting a 12-13 year low, mass selling has slowed down, and in fact, FIs have been net buyers in the recent sessions. This signals that the confidence is returning, and stocks like HDFC, ICICI, Kotak have been FII's favorites. So, if the FIIs are coming back, banks could benefit massively. Banks were facing a tricky situation. Loan growth was outpacing deposit growth. That meant banks had to increase deposit rates, hurting profitability. But why was the deposit growth slow? Higher competition from small finance banks, fintech companies offering better returns on deposits, investors parking their money in alternative assets like equity and mutual funds instead of bank deposits, and inflation eating into household savings, reducing surplus money available for FDs. However, with improving liquidity conditions and stabilizing inflation, we're likely to see better deposit growth, which will help banks maintain their margins. Now let's talk about NIM, or net interest margin. Think of banks like a store that deals in money. They buy money from depositors and then sell it to borrowers at a higher rate. The difference between the interest they earn on loans and what they pay on deposits is their net interest margin. Why has NIM been under pressure? Rising deposit costs. As banks were forced to offer higher interest rates to attract deposits, cost of fund increased. Competitive lending rates. Due to competitions, banks couldn't significantly increase their lending rate, squeezing their margins. And regulatory changes. RBI's monetary policy decisions also had massive impact on the costs of borrowing and lending. But with inflation cooling down and interest rates expected to stabilize or even decline in the next few years, banks are in a better position to expand their NIMs. This is a slow but steady process. As rates normalize, profitability will improve. The broader economy has faced challenges. Wars, high inflation, low demand, and high interest rates. All these factors have impacted banking stocks. However, things are looking up. India's GDP growth is stabilizing, inflation is lower than expected, and the recent budget introduced tax changes that will leave more disposable income in the hands of middle class, boosting demand. Unlike many other economies struggling with global tariff wars, India remains relatively insulated due to its protectionist economic policies. This means that banks operating in India are shielded from some of the major shocks affecting the global financial system. Bank valuations have also played a role in their underperformance. High valuations often lead to corrections if earnings don't keep pace. But right now, valuations look attractive. Nifty 50's PE is somewhat at a fair range. Bank Nifty, although, its PE is trading at a decade low. Historically, when valuations are this low, we've seen a strong rally in banking stocks over the next few years. This could be a once in a decade opportunity for investors. Investors have been focused on other sectors. Defense, railways, and even retail saw a massive rally in the past few years. Banks, not so much. But the fundamentals are just too strong to ignore. Could this be the year when banks finally take off? Now that we've covered the macro picture, let's look at two major players, HDFC and Kotak. HDFC Bank has doubled its revenue and profits since 2021. But has the stock price doubled? No, that means there is still a significant upside potential. Sitting at its highest ever profits with a below mean PE, it has already rallied in the past 1 year. But in the long term, HDFC still looks incredibly attractive. It has a strong loan book growth, it is expanding into rural markets, and its integration with HDFC Limited after the merger is boosting its overall revenue. Kotak Bank has seen a 70-80% jump in revenue and profits since 2021, but its stock price hasn't, in my opinion, grown in tune with these. These numbers suggest a strong growth potential. Banks have held strong even during economic downturns. They are considered defensive bets, essential for an economy to function. And in uncertain times, a defensive bet is also a safe bet. With FIIs returning, valuations at multi-year lows, and improving fundamentals, private banking might just be the sector of the year. So, what do you think? Will private banking dominate the next few years? Drop your thoughts in the comments below. And if you found this analysis valuable, make sure to like, subscribe, and hit the bell icon for more deep dives into the stock market. See you in the next one.